Professionals. It's what we do. Mortgages, you know? So, hey, welcome everybody. We are live. It's Thursday at 10 a.m. Keith Pitch. I'm with Loan Depot. I am also co-host here at Real Estate Now with my co-host Stacy Chevalier. Stacy, good morning.
Good morning. Happy Thursday.
Happy Thursday. Is it frozen where you're at? It's frozen here.
I don't know. I'm just dreaming of
Have you been
moving
outside today?
somewhere warm. I hear an echo. Do you hear the echo? I think we need to fix that. Just ask
I don't hear
Keegan.
an
I
echo.
can see Keegan, but Keegan, do you hear an echo? Yes.
Echo.
No
Here,
one's
let me turn
watching.
that down.
Time to fix it.
No one's watching. You can fix it. It might be with my mic. There we go. How about now? Do we have an echo?
That's better.
Better? Better. Okay, let's roll with that. Um, so Stacy and I, we talked last, or was it last week? Yeah, no, actually last week was Thanksgiving. So happy Thanksgiving, everybody. So the week before last, we were talking about doing a year in review with 2020, and then looking forward to 2021, because here we are, December. There's going to be lots of folks out there that on their New Year's resolutions are going to say, hey, let's go buy a house, let's go refinance the house, let's do something financially oriented. And we just wanted to put some context behind it and help everybody understand what they can look forward to in 2021 with a little context of looking back in 2020. But before we do that, we're going to do something we do every week. Otherwise, we'd be totally remiss. So I'm going to share my screen here, add to stream. There we go. There it is. Mortgage rates reach another low or record low.
Another record
What do
low.
you have to say about this?
What are we on?
Broken record, Stacy.
Is this like 14 in a row?
Yeah, I think it's either 14 or 15 in a row that we've bottomed out. I was scouring the interwebs this morning trying to figure out the terminology for dragging your anchor across the bottom. I couldn't find it, but we've been dragging the mortgage rate anchor across the bottom of the rate environment all year, all year. So I want to go back and bring that back in. One thing that I was looking at, which was super, super interesting, I set this to 1 year. So let me see if I can't zoom it in. See if we can make that bigger. Oh, I want to make this one bigger. There we go. There we go. Yeah. So right now we're down here at 2.71, right? Just a year ago, December, we were at 3.68. We were a whole point higher in interest rate.
Yeah, and what we were told a year ago was that rates would just kind of stabilize and not move through 2020.
Right. Correct. So I guess to that, I mean, here's where coronavirus pops in, makes headlines, really starts to impact the whole world. We go through this march of uncertainty based off of everybody's pipelines literally filled overnight with a bunch of loans, and the market's like, oh my gosh, what's going on? So the market took pause. We didn't know how the CARES Act was going to roll out, and then we've just steadily gone down. It's like a slide. If I was a kid in elementary school, I'd be totally on the 15-year fixed slide, because this is just
That's such a cute statement.
It looks fun. So
Awesome.
today we want to talk. We're going to talk in two different segments. Segment number one: what does refinancing look like in 2021? Segment number two: what does buying a house look like in 2021 as far as your mortgage is concerned? Because I mean, it's what we do. We want to share the love. We want to empower as many people as possible to understand the systems that they're going into and what that looks like, so they can have the best experience possible, right? I want. We used to have a hashtag. Are we still doing making mortgage cool again? Are we still doing MMCA?
Yeah.
Because when I rolled into Loan Depot, we were doing MMCA, Make Mortgage Cool Again. Mortgages are cool. They're very powerful financial tools, and the more you know about them, the better off you are to really take advantage of the power that is a mortgage. So we're going to look into our crystal ball with those two eyes today. So we talked about refinance rates. So let's just stay there. Stacy, what's the word on the street about what the MBA is saying for next year?
So the MBA is saying that rates will slowly climb back up to a high of around 3.3. So, still very, very low rates, but it's a very uncertain market with, some states, including ours, are back to stay-at-home orders. So it's very dependent on, the vaccine and when we can open back up, and if we open up and then shut down, but that's so far the prediction. I got to get my glasses on.
Oh, we're not here. Let me just zoom in on that. There we go. So yeah, their forecast is to go back up to the mid threes or the low mid threes, somewhere between 3.25 and 3.5. Which could disqualify people, right, from either refinancing or from a net tangible benefit standpoint, or in a purchase, it maybe putting that payment just out of reach so they don't qualify. So when we're talking about the difference of now, that's almost a half a point in rate. It is a half a point in rate between 2.125 on a 30-year fix today going to 3.3. So it will have some impact on the market. We want to talk. I want to just reiterate. Not only have we had historic low interest rates, our volume as an industry has been through the roof. And a lot of folks have come to us and like, hey, can I get that refinance done in 20 days? Can I get it done by the end of the month? Here we are on the 3rd of December. Can I get it done by the end of the month? And I want to set expectations, whether you're looking to refinance or purchase. The market, the capacity that we have on the mortgage side to process loans has been taxed, and it's been taxed very, very heavily, not only through, as Stacy mentioned earlier, that everybody's working from home trying to get these mortgages done for all of our customers, but we're also trying to navigate, I feel like a builder right now. We're trying to navigate the people side of the business, as far as there is not enough people in this industry right now to approve all the pipelines and get them done in those 2019 and 2018 turn times that we had, because the volume is just so huge. So I wanted to speak to that.
Yeah, so we think we're gonna fall around a $3.2 trillion market. So to put that in perspective, that's the highest market we've seen since 2003. So 17 years ago, and I think we had a market of around 3.8 trillion. And so to your point, Keith, there was no way to prepare for the second highest market in 20 years in a 2-week period, essentially from when the country shut down and then the rates dropped and the pipelines filled up across the country. So I do want to just take one moment to thank everybody that's in our industry. Thank our ops partners, thank leadership, thank all the companies out there. I know everyone has worked extremely hard in 2020 and trying to do right for the consumer. And it is a hard thing for a consumer to understand. Why can't we get things done in 5 days like we used to? And it's just, it's was something we'll have to work through. So we don't want to make this a Loan Depot show, but I know everyone, again, and across the industry, worked hard with hiring people and right-sizing operations.
Yeah, and it's an ever-evolving situation. And I was trying to think of a really poetic way to put the pipelines that all of us in the mortgage industry are facing right now. And it struck me the other day. It's kind of like taking a straw and trying to shove a watermelon through it to have it come out the other side. So that's where we were as an industry. And looking forward to 2021, do we see much change going on, Stacy? What do you What are we seeing into 2021?
So 2021, I mean, from what we're reading is we'll be around a $2.5 trillion market. So we'll go down a little bit. Purchase market is going to be extremely high. Could be the highest purchase market we've seen in 20 years. So it could be, if the rates truly do, go up even a little bit, then that will slow down the refinance market. But as I've been saying, I think rates are just going to keep falling. So I'm going to stick on that train, and I'm not sure that we're going to hit that next year. So I do think we've done all the work needed to support larger pipelines, and so I think it'll be a much smoother year for everybody, regardless of the mortgage industry size.
Yeah, and I'm going to take a counter position to you, Stacey, because I think rates will start to tick back up. There's a few wild cards, and everybody needs to understand these wild cards that are in play right now. We will have an administration change, with the Biden presidency. What does that mean for the mortgage market? What does that mean for housing industry? We haven't vetted that out, so we don't know. That's an unknown. The other thing is there's still lots and lots of talk about taking Fannie Mae and Freddie Mac out of conservatorship. They've been in the care of the federal government ever since the mortgage meltdown. So that's really going to possibly have a fundamental impact on rates when they come out of conservatorship, because then they're no longer on there's no safety net of the federal government buying all these mortgages that we're securitizing. So what is the secondary market going to want with regard to their yields and their hedge on those now that they're no longer under the tutelage of the federal government? So those are two key fundamentals that, I don't have a crystal ball. I flashed on the screen that we were looking into our crystal ball. I don't have a crystal ball to know what true impact that's going to have until we're standing there on the spot. That will really dictate where we're going, in my opinion. And quite frankly, on the tick up of the interest rates, 3% still amazing money, people. Amazing money. And it will help all of our folks trying to purchase have easier, more convenient turn times. So we'll see how that all plays out.
Yeah, and definitely still, to reiterate, it's a great time to purchase. So we are estimating, the industry's estimating a $1.54 trillion purchase market, which will just gain the largest purchase market we've seen since 2005, and should be larger than the 2005 market. So it's going to be a very busy year for our realtor partners and for all you lucky home buyers.
Well, I changed on the screen. We're going to flip over to purchase. If you guys have any questions throughout this, let us know. Love to answer those questions as they come in. But everybody's like, well, you guys did it before in 2005. Why can't you do it again in 2021? And I chuckle when I say that, because I was at a mortgage wholesaler at that point, and we did no doc loans, right? So there's a very big difference as far as our due diligence and underwriting process in today's market as opposed to 2005. 2005, you have a credit score and you could sign your paperwork, you got a loan, right? That's what we did, right? In 2021, you're going to be required to provide all your income, all your asset documentation, and make sure that you can actually legitimately buy that house. So
or get digitally verified. Maybe not necessarily provide documents, but yeah. I do want to say for the record, I didn't work for one of those companies. I did not originate those no doc loans, but we'll say Keith did.
Yeah, I didn't originate them. I was the wholesale outlet that underwrote them. Okay, let's be clear. So
maybe we should pull up the new loan limits so people can see what they.
That's where I'm going next. We're still there on the MBA, but this is the huge news and great relief for us locally in the Tri-County area. That is, but the FHFA announced, was it last week? The new conforming loan limits right before Thanksgiving, wasn't it? Yeah. So effective in January 1st, 2021. That's so weird. I'm so used to saying 2020. Now saying 2021 is it's new, like anything else. So you can see there, this is the heat map of, there's conforming loan limit. Whoops, what did I just do? I just pushed a button. So there's conforming loan limit, which went up to $548,250, which is great. So if you're outside King County, Pierce County, Snohomish County, your new conforming loan limit for Fannie Mae and Freddie Mac loans is now 500, almost 550, 548,250, which is super awesome.
So that's like where most of the country falls. That's the whole gray area, right?
Yeah, the whole gray area is where the rest of the country fall. The super high areas are the dark orange, the burnt orange. So they have a new loan limit of 822,375, and King County, Pierce County, and Snohomish County are right in the middle here in the, what are we going to call that, light yellow. So we had a nice bump of about $30,000 to have our high balance loan limit $776,250 on a single family residence. So what this allows us to do is it allows us to get more people into the Fannie Mae, Freddie Mac, standardized underwriting, very clear, very convenient, very, I don't want to say very easy, a lot more user-friendly underwriting guidelines. When we get a loan amount above that 776, 250, you got to go to the jumbo market. And the jumbo market has a lot more restraints on borrower assets, credit, and income qualifications. So super awesome for us to do that. If we back into the numbers, that means somebody buying a 776 or using a mortgage at the top of the loan limit of 776, 250 divided by 0.95, you could buy an $817,100 house and put 5% down. So that's a pretty powerful tool for what is still the biggest hurdle for most first-time home buyers is that down payment. So you could get in as little as 5% and utilize that higher loan limit to buy that $800,000 house. Super powerful here in King County, Snohomish, and Pierce County. So I'm looking forward to that.
So those go into effect for in 2021. So companies should be able to start originating those loans come mid-December.
Correct. Yep, we can start locking those in with closing dates after the first of the year. So NAR's forecast, National Association of Realtors, to Stacy's point, it's going to be another great year to buy real estate. The awesome thing is we're going to see interest rates stay low. We're going to see appreciation continue to go up somewhere in the 3%. This is a national number. Locally, when we talk to our Matthew Gardners and Denise Lones's, we're looking probably somewhere of local appreciation between the 5 and 9%, depending on where you're at in the greater King County area. So that's another huge year for us. And I'm super excited for all you folks out there that are right now in the trenches. I want to speak to you because it's become very apparent in the most recent past that I want to say, get a real estate agent that has your best interest at heart. Okay, I'm going to leave that there for a second. Get a real estate agent that has your best interest at heart. I have seen, I've seen through the network of our loan officers here in Washington State, some very aggressive negotiations. I get it. It's super busy out there. It's super competitive, but we got to be careful not to jeopardize your situation. I want to give you guys all an illustration that came to us. The transaction came to us yesterday. We got it disclosed. I take that back. It came to us on the 1st, and the closing date is the 28th. And this buyer is putting out a large deposit, earnest money, and it's non-refundable. They waived inspection, they waived finance contingency, and they're $100,000 over the asking price.
Wow.
Right? And they're closing on December 28th, the Monday after Christmas. And I asked my loan officer to reach back out to that agent and say, agent, we got to make sure that we're watching out for our clients. There was no conversation between that agent and our loan officer on whether A, we could make that closing date happen, right? There wasn't. This person, this buyer, has all their money on the line, right? Because if we don't hit that contract date, there's recourse. The seller could just turn around, take the non-refundable earnest money, and relist the house, right? So make sure that if you are negotiating these things with your real estate agent has 110% expressed what every single one of these pieces of the contract are doing for you to protect you. There's a reason why this purchase and sale agreement is boilerplate. It's been approved by all the associations, the realtor associations that have different multiple listing services throughout our state. It's because it's to protect you, the buyer, right? So every time that you scratch through one of these boilerplate contingencies, you're at a higher risk of that transaction. So I just want you guys to know that it's okay to get aggressive. I'm not saying don't get aggressive to win the deal, because I'll share this with you. I was looking at this, Stacy. This just knocked my socks off. So we're talking about an $800,000 house, right? I went to our friends over at Redfin. Right now in the Seattle area, Seattle proper, right? Keep in mind, Seattle proper has over 800,000 residents. Single family residences under $800,000, there's 197 for sale right now.
Wow.
That's it. For 800,000 people, if you want to buy a single family residence, there's a pool of just under 200 houses that you could go buy today at 800 or less. So I say that because I get where you guys are coming from. You want to win a house, but I want you to be cautious. I want you to understand all the situations. Work with a seasoned agent. If you don't have a seasoned agent, find one. We can help you. There's lots of resources out there to vet your agents, and know every single contingency that you're putting a red X through. It is now exposing you, the buyer, to not be able to get out of that contract should something fail. So I want to put that urge. I'm done preaching. I'm getting off the soapbox now. But super.
And we can pre-qualify people, before you find a property to take some of that stress off, get the process started, give your lender, whoever you work with, a little bit of time to make sure you get underwritten for those quick closes.
And confirming that closing date, especially with the holiday season upon us, we need to make sure that we're dialing in those closing dates, and knowing that your lenders, specifically if you're going to waive the finance contingency, can perform, right? Super, super important. The other thing too, I've noticed appraisers like to take holidays off too, and we don't control the appraisal. No lender controls the appraisals, right? Appraisers are out there. They live amongst us. But we send the order out. You bring your purchase, you bring your refinance to us. We send the order out to a panel of real estate appraisers, and then we typically see a little bit expansion in their turn times during the holiday season, because they're like you and I, that they want to go on vacation too. So, well, I don't know where they're going on vacation, maybe to their backyard. But at least we do tend to see a little bit of elongated turn times in that respect. Let me close that down. Remove that. One other thing that I wanted to talk to, both on the purchase and the real estate, and the purchase and the refi market. This goes out to all my self-employed folks out there. You guys have been trudging through it. I love you. Keep it up. We need our small businesses. We need our medium-sized businesses. Your taxes that you file for 2020 will immediately impact your qualifications in 2021. Okay, so I know it's been a hard year. If you're looking to go out and buy, if you're looking to go out and refinance, it's worth a conversation with a mortgage professional before you file those taxes on what the implications of that K1 will be, what the implications of your 1120s will be as far as your qualification in 2021. What happens for the self-employed individuals out there, we take a 2-year look back, and if the most recent year that you filed has a deviation at a certain amount, somewhere between 20 and 30%, if you come down in income, we're only going to look at the last year, right? So does that last year's worth of business income support your new purchase, your new refinance? It's a super important question to ask. So just a quick throw out to all my self-employed individuals, whether you're buying or you want to refinance. Now is a good time to do that. We're not requiring 2020 tax returns until you get until we get to tax time. So, what else can we tell them to prepare for 2021, Stacy?
Well, I mean, it's not a fun topic, but our unemployment rate is higher than it's ever been. And we don't feel it like we felt it when homes were going into foreclosure years ago because of the package and forbearance package. But that's we could start to see some of that happen next year on the longer forbearances if there's no way to start paying that mortgage. So I think that's something to look for. Keith and I want to be helpful to our community. So if you are someone out there that knows a food bank that needs help or whatever, please just drop us a line and let us know. We know it's not easy for some people to be out of work. So, but yeah, I just think that's something to look for next year if we're going to start to see some foreclosures and short sales as well.
Yeah, and one thing that I learned that I'd love to share from the mortgage meltdown is sometimes it's better just to clean the slate and move on than it is to try to hold on. And I totally get it. And there's lots of folks that came through the mortgage meltdown and were underwater. They didn't want a short sale. They wanted to renegotiate loans. They wanted to do this. They wanted to try their best. And don't be afraid to engage with a real estate agent and look at what a short sale would be. Don't be afraid to go back to the bank to renegotiate. Knowing where you're at is a very powerful place because it allows you to move from there, right? But go ahead and make those decisions. They're hard decisions sometimes if it involves a foreclosure or a short sale. The silver lining in this whole pandemic and the folks that do have homes out there, we have the highest equity position in houses that we've ever had in the last 3 decades. It's just amazing. And so, though it may sound bad to sell your house, it may not be a short sale. You may be able to sell that house, clear the mortgage, and move on with your life, which you could then turn around, get your credit healthy again, and buy another house. But sometimes we just have to hit the reset button. And that's not a bad thing. It's just starting over. I saw so many people in the mortgage meltdown try to hold on, only to wait 2, 3, 4 years and then end up in the same place that if they just would have saw from the very beginning the situation and got the right professionals in place, they would be through it and they'd be back into the mortgage market. So I know everybody out there that is still on unemployment, that they're talking about kicking out foreclosures again until the end of January 2021. We haven't confirmed that yet, but there's talk about that. What we can do is help you in any way, shape, or form. So don't be afraid to pick up the phone, talk to your mortgage professionals, talk to your real estate professionals, and figure out the best plan for you and just get after it. So, yep. On a high note, the National Association of Realtors, I like to leave on high notes. We're getting close to 30 minutes. Appreciation for those of you that do have your houses. We're going to have another great appreciation year. So keep paying those mortgages, keep doing what you can do, and we'll continue to help you out on the mortgage side. Any final words from you, Stacy, here today?
I just again want to thank just everyone who did go through the refinance here or purchase. Thank you for your patience, your support, and we appreciate you all. And one final shout out to all our ops teams.
Yeah, absolutely. Our ops team's been amazing. So. Yeah. Right on. Well, next week we're gonna tee up some tiny homes. It's been something that's been gaining momentum. Tiny homes come in lots of shapes and sizes. We've got tiny home builders as well as the new rage in downtown Seattle is detached, the detached ADU, the auxiliary dwelling unit. A lot of folks have those mother-in-laws that they've converted that downstairs basement into a mother-in-law. Now the city has a streamlined process for those of you that want to add a little cottage house in the back, 700-800 square feet. We're going to jump into what that looks like and how you can take advantage of it. So thanks for tuning in today. We'll see you next Thursday at 10 a.m.
Sounds good. Take care, everyone.